Okay, so we are now working on valuing accounts receivable, brand new concept. This is something that's brand new that you've never worked with before, okay? So in accounts receivable, when you work in accounts receivable or when you have a company and you use accounts receivable, unfortunately, everybody that you bill doesn't always pay you. And so there's some portion of loss that occurs in the process. And what companies do is they put this amount of money that they lose to something called bad debt expense. Now, some companies incorrectly do this, and what they do is that every time a debt goes bad, like someone calls and says, hey, I'm not paying my bill, or you call them and they're like, hey, I went bankrupt, I'm not paying the bill, you would go in and put it to bad debt expense. That is not the correct way to do it. We're going to learn how to do it that way, but it's not the correct way to do it. We're also going to learn the correct way. And the correct way is that at the beginning of the year, you actually make an estimation of how much debt you think is going to go bad. And it's what they call allowance for doubtful accounts. It's an allowance you're making because you're doubtful that this amount of money is going to be paid in the year. And the reason why you do that is because, remember, if we go all the way back to the beginning of the class and we were looking at those rules of accounting, one of the rules is faithful representation, right? We want to make sure that the records that we are producing are a faithful representation of what we know to be true. And if we know that a percentage of accounts receivable are always going to be going bad, it is our responsibility to account for that and show that within our books, so that if we know $500,000 a year goes bad and we show $1 million in accounts receivable on our books, but we don't show that $500,000 that's probably going to go bad, we're doing a grave misservice to our stakeholders, because they're looking at that $1 million thinking we're going to collect it all, and we're not. So that is what this is about. This is about creating that faithful representation. Now, just because you estimate 500,000 is going to go bad, it may not go bad, but you have to put in the representation of what's going to go bad. Now, in all of the problems here, they're going to tell you how much the allowance needs to be. In the real world, if you worked in accounting, you might be the person that figures that out. And we're going to look at something here that talks a little bit about how it's figured out, but you're not going to have to figure it out in this class. You're going to be told what the amount is for the allowance. Okay, so the direct write-off method is the one that we don't want to do. And the direct write-off method is one where they directly write it off only when they know debt is going to go bad. We are going to be learning how to do that, just because when you go into work for companies, a lot of companies do it that way, and you'll be able to say, hey, this isn't the right way to do it. Let me show you how to do it the right way. And then we're going to learn the right way, which is the allowance method, okay? And that is required by GAAP. GAAP does require that you use the allowance method. All right, so first is the direct write-off method, right? So the direct write-off method says, or this problem says, assume that Warren Company writes off M.E. Doran's $200 balance as uncollectible on December 12th. So that means that they either called M.E. Doran on the phone and said, hey, how come you haven't paid your bill? Or M.E. Doran called them and said, hey, we're not paying our bill. And so the company warden would try and collect the money multiple times before they would write it off, but we're not getting into all those details in here. So to write the debt off, warden's entry is they're going to debit bad debt expense, $200, and they're going to credit accounts receivable, $200, okay? So this is an example of what they call the direct write-off method. It is not the method you should be using, but you will do this in your problems just to show that this is how this method is done, okay? All right, so that's called the direct write-off method, okay? Okay, the other method, it's a little more involved, of course, but hang with me for a second and you'll kind of get how this works, okay? All right, so the allowance method, they call this allowance for uncollectible accounts, or allowance for doubtful accounts is the name of the account that we're going to be using. It's a new account, allowance for doubtful accounts, just like bad debts is a new account. Bad debt expense. So what happens with this is that companies will estimate what they think is going to be uncollectible. Generally, companies will do this at the beginning of the year, and then they change the number at the beginning of the next year. sometimes if companies have had like a really bad year, like right now, companies might be doing adjustments to their allowance for doubtful accounts at another time if they know like a bunch of stuff is going to go bad. So when you do the allowance method, once you figure out how much the allowance is supposed to be, you're going to debit bad debt expense, and you're going to credit allowance for doubtful accounts. Now, allowance for doubtful accounts is a contra asset. So remember, an asset has a debit balance, right? And a contra asset means it has an opposite balance, or another way to look at it is that the contra asset subtracts from the asset. So in your financial statements, you would show accounts receivable, and then right below it, it would have the allowance for doubtful accounts that would be subtracted from the accounts receivable. And the reason why that's done is it's to show, you know, hey, we billed $500,000, but our allowance for doubtful accounts is $100,000. So we're only going to realize, or we're only going to collect $100,000 or $400,000. Okay, we're going to lose $100,000. When you do the allowance method, let's say you do the allowance method in January, and then in March, you actually have an account that goes bad. Somebody calls you on the phone, or you call someone and they're like, hey, I can't pay my bill. So now it's no longer doubtful it's going to go bad, right? You're not making an allowance that is doubtful it's going to be paid. An account is actually going bad. So you're going to be taking it out of the allowance for doubtful accounts and crediting out the customer's account. So what you're going to do is you're going to debit allowance for doubtful accounts, and then you're going to credit accounts receivable. That means that this account actually went bad. You're not doubtful it's going to go bad. It went bad, and you're taking it out of your books. It's gone, okay? All right, so let's go to the next slide. We're going to look at an example here. Actually, did I do this first? I'm going to show you something else first. Well, no, let me show you this, and then I'm going to show you something else. Okay, so Hampson Furniture has credit sales of $1,200,000 in 2014, of which $200,000 remains uncollectible at December 31. The credit manager estimates that $12,000 of these sales will prove uncollectible. So what you want to do is you want to do the entry to get that money into allowance for doubtful accounts. So December 31, you're going to debit bad debt expense for $12,000. And you're going to credit allowance for doubtful accounts for $12,000, all right? Now, here's the very important part. On the bottom there, it says, above adjustment assumes allowance for doubtful accounts had a zero balance before adjustment. This is going to be really important that you pay attention to your problem. And I'm going to share with you an Excel sheet now. I'm going to stop sharing this PowerPoint. I'm going to share an Excel sheet with you. And we're going to go over some stuff that has to do with what the balance is in allowance for doubtful accounts, okay? All right. So I don't want you to look at this yet, that part yet. Okay, so when you're doing these problems for doubtful accounts, right? The question you always want to ask yourself is, what do you want the balance to be in allowance for doubtful accounts? What do you want the balance to be in allowance for doubtful accounts? Not what the dollar amount is they're telling you, or not what your entry is going to be, but what you want the balance to be in allowance for doubtful accounts, okay? Because your entry is not always going to be exactly what you want the balance to be. The only time your entry is going to be exactly what you want the balance to be is when the balance in doubtful account, allowance for doubtful accounts starts at zero. So I'm going to show you an example here, okay? So in that problem we just looked at, the allowance for doubtful accounts had a beginning balance of zero, okay? This is the allowance for doubtful accounts, okay? It had a beginning balance of zero. There's nothing there in the credit side, right? There's nothing there. So what we want the balance to be is $12,000. $12,000 was being written off, okay? So we are going to credit allowance for doubtful accounts $12,000, and that's what's going to give us a $12,000 balance in that T account, okay? Now, this is going to take us back to chapter 3. Remember how I said chapter 3 is your friend and it's going to follow you through all of accounting? This is going to take us there. All right, so let's pretend that allowance for doubtful accounts, okay, we're going to look at another scenario. Allowance for doubtful accounts has a credit balance, okay? So let's say that the allowance for doubtful accounts has a credit balance of, actually, I just pulled this up here, has a credit balance of $1,000, okay? So if allowance for doubtful accounts has a credit balance for $1,000, look at this rule up here. You're going to want to write this down. You're going to subtract the amount of the credit balance from the amount you want the balance to be to get your entry, okay? So in this case, if you look below, $12,000 is what we want ADA to be, okay? Is $12,000, right? Minus the credit balance equals the entry, okay? So if we look down below, you're going to see $12,000 is what we want the ADA to be. It has a credit balance of $1,000, so we're going to subtract that. That's going to give us an entry of $11,000. Now, if you look down below at the T account down here, you'll see we have a credit balance of $1,000. If we debit or if we credit that account $11,000, we are now going to have a credit balance of $12,000 when we balance that account, and that's what we want the balance to be, $12,000, okay? So the rule is if the ADA has a credit balance, you subtract the amount of credit from the amount that you want it to be to get your entry, okay? So you'll want to write that down. And we'll do a sample of each one of these too, okay? All right. Now, if the allowance for doubtful accounts has a debit balance versus a credit balance, okay, you're going to add it to the amount that you want it to be, okay? So let's look at the same example then. We want it to be $12,000, right? We want this entry to be, or we want the ADA to be $12,000 at the end, right? I'm just moving this up here so you can see it. Okay, we want the ADA to be $12,000 in the end. It has a debit balance of $100 or $1,000. So we're going to add the debit balance to what we want the entry to be. And that's going to give us an entry of $13,000, okay? So we are going to credit allowance for doubtful accounts $13,000. And then when we balance that account that started with the $1,000 debit, we're going to get our balance at the end of $12,000. And that is what we want. That's what we're always looking for. What do we want the ADA to be at the end? What do we want the ADA balance to be at the end? Okay. So if it has a zero balance, your entry is the same as zero balance. Your entry is the same as what you want the number to be. And we want the number to be 12,000 for all of these examples. If it's a credit balance, you're going to subtract the credit balance from the amount that you want the number to be to get your entry. If it is a debit balance, you're going to add the debit balance to the amount you want the number to be to get your entry, okay? All right, so I'm going to take us back over to the PowerPoint because we're going to look at samples of these, other samples. All right, so let me stop this. I'm going to share the PowerPoint. Okay, so we already looked at this one here. This one here is showing us that we want it to be $12,000. It doesn't tell us what the balance in the allowance for doubtful accounts is, so we're just going to assume it's zero if they don't tell us. So our entry is going to be actually how much we want the account to be, okay? The next slide is just showing us what it would look like on the financial statement. So they're showing you that the accounts receivable is $200,000, but once they take out the allowance for doubtful accounts of $12,000, they're only going to realize $188,000. Okay. Now, oops, too far down there. The next slide. Oh, that's not the right one. Hold on. I went way too far, I think. Hold on. Let's see. Oh, you know what? They're not showing us the other part. Okay, I'm going to skip down and then we're going to come back. Nope, that's not it. Okay. Just hang on to what I just showed you there. We're going to go into another part here. So remember I told you that the problems here are going to tell you how much you want the number to be, okay? All this slide right here is showing you is that this is the way that a company or an accountant is going to figure out what that dollar amount is. And what they often do is they base it on what they call an accounts receivable aging, okay? And what the aging is it shows, each customer name, how much the customer owes, and how old the money is that the customer owes. So for instance, it shows T.E. Adert owes $600, and of that $600, $300 is 1 to 30 days old, $200 is 61 to 90 days old, and $100 is over 90 days old. Now in the real world, T.D. Adert probably wouldn't have been able to buy that 1 to 30 day old stuff because they have so much money that's due in 61 to 90 days and over 90 days past due. But there could be things that sometimes are happening with this customer. And this is where if you work in collections, you would be printing this report several times a week and you would have your own handwritten notes. So maybe that $100 that T.E. Adert owes is for a product that they bought and it was shipped the wrong color. And so we had to ship it back to the painting factory for them to change the color of the product. So even though it was billed over 90 days ago, the customer still hasn't got that product, so it hasn't been paid yet. So we might have notes on the aging about that. We don't take it off of the books. It stays on the books until that product is taken care of. But we still use that as part of the estimation. So you'll see that on the very bottom in red is the dollar amount they think is going to go bad for each of those sections. And right above that, you're going to see a percentage. So the person that did this estimation says that they estimate that 2% of what's not due yet is going to go bad, 4% of the 1 to 30 days, 10% of the 31 to 60 days, 20% of the 61 to 90 days, and 40% of the over 90 days is going to go bad. So that's how they come up with their number. Again, you're not going to be doing that. You're going to actually be getting the number. Oftentimes, companies will also base the number on what they had the prior year, and then some kind of a percentage increase on top of that. Okay, so we're now going to look at the example I was showing you on the Excel sheet. So assume that the adjusted trial balance shows allowance for doubtful accounts with a credit balance of $528. Prepare the adjusting entry assuming the $2,228 is the estimate of uncollectible receivables from the aging schedule. So the rule tells us that if the allowance for doubtful accounts has a credit balance, we're going to subtract that amount from the amount that we want the ADA to be in order to get our entry. So in this case, we're going to be taking $2,228 minus $528. That's going to give us our entry of $1,700. So we are going to debit bad debt expense, $1,700, and we're going to credit allowance for doubtful accounts, $1,700. Okay. Let's see. I want to see what this one is here. Okay, so we're going to do 8-5 together. So I'm going to stop sharing this. I'm going to share the Excel sheet. Actually, I'm going to stop the recording and then do a new one.